in the overview of currency statement, we see the ending situation of each currency in each area. Now, we want to know why is in the US there are 649,000 left, an overdraft of this many dollars in Europe, an overdraft of this many dollars in Brazil, and an overdraft of this many dollars in Liechtenstein. Well, this is the following set of tables. This is exactly what they explain. There is a dollar table that gives you for the US, Europe, Brazil, and home office the currency situation. So what do we know? First of all, this is recording the exchange rate between the different currencies, the European currency, the euro, the Brazilian currency, the real, the Swiss franc against the dollar, which is one. So what this table gives you is first the receipt. How many dollars have been received in the form of cash payment or money transfer from one area to another or service payment, no matter how you deal with it, there is really a lot of reasons why you have received money. If you want to know more, there is an Appendix 4 in the Executive Guide, which is very useful because it will list all the sources of receipt as well as all the sources of disbursement. So this company has received nearly $4.6 million. They have expended 5.6, but fortunately they had, they spent more than they received, but they had a positive balance before, and so they, at the end of the quarter, are left with $649,000, which is what we see here. Okay, now this table will also give you for the area the account receivable in the next quarter and the following quarter, account receivable 9 and account receivable 10, as well as the account payable 9 and 10. And then the interest payment, which sometimes are positive if you have a positive balance, sometimes are negative when you have a negative when you have a negative balance. Now, what we see here is a little bit of an explanation of the situation that we had in Europe, which was strange. They have an overdraft of 1,821,000. How come? Well, there is a holding unit of 1,821,000 when nothing happened during this quarter. No receipt, no disbursement. That simply means in the previous quarter, they already had an overdraft of this many dollars. In Brazil, it's a little bit worse, you could say. They had an overdraft, no receipt. They have a disbursement of another $383,000, which leaves them with an overdraft of $639,000. Same in the US. They have dug the hole even more. They have added to their overdraft in dollars, and therefore they are in this situation. Furthermore, we see that they have a big payment to make in dollars in Europe in quarter 10. Same in Brazil. So that means they have to anticipate and probably get some cash in dollar in Europe to be able to cover this amount, and in dollar in Brazil to be able to cover this amount. Now, this sizable overdraft is probably what explains this $60,000 of interest, because for an overdraft, of course, you pay not as much as you pay for supplier credit, but this is still something that you would have been better off taking a loan to cover. Then you have some more information about realized and unrealized losses and gains that have to do with the situation of the currency, the fluctuation of currencies, and then the value of holding at the end. This is your sort of ending situation that is exactly copied right there at the beginning, at the top of this table, but here only in dollar, because all of these have been turned into euros in Europe, real in Brazil, and Swiss francs in Liechtenstein. And then, as usual, you have the consolidated column. You have another 4 tables because you have one such table, just as the one I just explained, for euro, for real, and for Swiss francs.